On April 29th, the Bank of Canada held its key interest rate at 2.25% for the fifth consecutive time. At first glance, this looks like stability, but when you look into the full report, the message is a lot more cautious. As we know, the Bank of Canada interest rate announcements have been widely anticipated over the past few years, and it directly impacts sentiment in the real estate market. Today, we'll break down the report and what it means. Rates are holding, but not settled. With Bank of Canada holding rates for 5 meetings in a row now, even with downward pressure on the economy, it tells us one thing: the Bank of Canada is not ready to cut rates just yet. At the same time, with upward pressure on inflation, they're not ready to raise. So right now, we're in a holding pattern, but that doesn't mean nothing's happening. Inflation is moving back up. Inflation is expected to rise to about 3% in the short term, and it's being driven up by energy prices. Higher oil prices are pushing up gas, transportation, and food costs, and all of that's being felt by consumers. Even though inflation is expected to come back down next year, the short-term trend matters because that's what the bank reacts to. The biggest driver here are elevated oil prices and global tensions. As we know, bond yields have been pushed up, which increases fixed mortgage rates, which are not tied to Bank of Canada's overnight rate. If oil prices stay elevated, that keeps upward pressure on inflation. And if inflation sticks around, the Bank of Canada has said they may need to raise rates, similarly to what we've seen with bond yields. At the same time, there's another force working in the opposite direction. US tariffs and trade uncertainty continue to slow parts of the Canadian economy. If that pressure persists, it could continue to weaken growth enough that the Bank of Canada actually cuts rates to stimulate the economy. So right now we have two competing forces. We have inflation risk calling for higher rates and economic slowdown calling for lower rates. And the Bank of Canada is waiting to see which one of these forces is stronger. This creates a very specific type of real estate market. It's not a stable market, even though the Bank of Canada has held rates for 5 consecutive meetings. It's more of a wait and see market. That shows up with buyers being more cautious, homes generally taking a little bit longer to sell, and constantly managing levels of inventory. There's uncertainty in both directions, which causes people looking to make moves in the real estate market to be more cautious, put plans on hold, or just wait for more certain times. So the headline is simple: rates are holding, but the reality is a little bit more nuanced. We're in a market where inflation has now become a risk, global conflict is causing uncertainty, and depending on what happens next, rates could go either way. If oil prices stay high, rates could go up. If we see this continued slowdown in the economy, rates could fall. But until then, expect more of the same. A slower moving market where uncertainty is still present. If you'd like more of a breakdown of how this is affecting prices, inventory, and activity in your neighborhood or region, reach out to us anytime. Thanks for watching, and see you in the next one.